Cool. We are now live online, if anyone's going to join us. Right, are we all back? Are we all back? No, not quite. Just waiting for a few more people to grab their pizza. So if you're watching this online or watch the video, I'm sorry we don't have any pizza for you. I wish I could ship you pizza, but we can't. But yeah, if you are watching this online, if you've got any questions, feel free to drop them in the YouTube chat. We'll make sure we get those questions to our speaker. So is that everyone? No, there's one more person. One more person. Okay. Okay, well, we'll kick off now, just for the sake of the folks on stream. So welcome, everyone. Welcome to the Microsoft Reactor in Redmond. Quick show of hands. Have you been here for an event before? Okay. Few people, 3 new faces. Awesome. Well, welcome to the Eastside AI, ML, and IoT meetup. We're trying to meet on the last Wednesday of every month. Obviously, one of the problems we're having at the moment is getting a good pipeline of speakers to come in and present for us. So we're really grateful for the folks in our community who want to come up here and share their knowledge and skills with everyone. Obviously, if you would like the opportunity to speak, if there's something you want to show off, a cool project you've got, or anything you want to come and talk about, please let me or Andrew know. And we will get you scheduled for a session. If you want to give a session, you've not done it before, you want help, you want us to give you the kind of presentation skills, lessons, anything like that, we can help you. We want to make sure that you can come and do this if you want to. So we're here to help. We've got a little bit of experience. I mean, I think one of the smallest audience I had was 1,600 people at a big tech conference in London. So, you know, we've been around a bit. So anything we can do to help you if you want to come up here and present, then please let us know. Now, the first thing we'll kick off with is our code of conduct. Okay, this is a Microsoft event. It's an independent meetup run at a Microsoft location. So everybody here is bound by our code of conduct. Okay, so Microsoft is dedicated to empowering every person and every organization on the planet to achieve more. This includes Microsoft Reactor events, where we seek to provide a respectful, friendly, professional experience for everyone, regardless of gender, sexual orientation, physical appearance, disability, race, or religion. We do not, and I repeat, do not tolerate any behavior that is harassing or degrading to any individual in any form. Individuals are responsible for knowing and abiding by these standards. We encourage everyone to assist in creating a welcoming and safe environment. Our asks of you is be aware of others, be friendly and patient, be welcoming and respectful, be open to all questions and viewpoints, be understanding of differences, but most importantly, be kind and be considerate to others. Now, so we have a zero tolerance policy. So if you are aware of a code of conduct breach, please report it immediately to me, to Andrew, or to Askia by the door, and we will get it resolved. The person will be removed. If you are uncomfortable or unable to report immediately, email us at reactorred@microsoft.com. Anybody who breaches our code of conduct will be removed from the building and banned from all Microsoft events going forward. We have a very large legal team. Do not try us. I cannot emphasize this enough. A community is only a good community if we feel safe with each other. And so if we do get a code of conduct breach, we take it very, very seriously. You do not want our lawyers coming after you. Okay. Now, this event was hosted by the Microsoft Reactor, so big thank you to the Microsoft Reactor for letting us use this space for free. I actually work with the Microsoft Reactor, so you know I've got a vested interest in promoting it. We host a number of events online and in person. If you go to aka.ms/reactor, you will see all of our events that we have coming up. But also, this space is available for community events. So if you're involved in a tech community and you want to bring your community here, run a meetup or other event, this space is available to you for free, as long as your event is free and open to your community. And so with that, I will pass over to our speaker for tonight. So give it up for Lakshay.
Do I have to switch?
Just go back to the thing you did before on the display settings. Yeah, if you just literally just do that again. So displays, and then AirPlay display. Reactor pods. Oh, if anyone asks a question, I'll run it with the microphone, just that way.
Sounds good. Am I audible? All right. Good evening, everybody. Thank you for joining today. I hope I can share something interesting with you today. please, I want this to be interactive, so feel free to ask questions in the middle and we can discuss. I don't want this to be just one-way conversation. It gets boring. My name is Lakshay. I'm a senior machine learning engineer at Euclidean Technologies. It is a asset manager, investment management firm in Seattle. We are transitioning into becoming an ETF, which is exciting. And today we're going to be talking about quantitative investing and modern machine learning and how these two kind of fields come together, which is where I work. So let's begin. For today's talk, I want to basically answer 3 questions. What is quantitative investing? Some of you might know, some of you might not know. How is machine learning kind of related or help the field of investing, and more specifically, quantitative investing? And then finally, is it any good? Machine learning as a field has a problem of too many solutions chasing too few problems. And we want to make sure that if we're going to apply this solution, does it actually help, or the advantages or sort of benefits are very small. So basically, this is the order, and I hope I can give answers to kind of these 3 questions today. So what is quantitative investing? In the stock market, or more specifically equities, there are kind of 2 broad-based kind of categories. There are more than that, but to keep it simple, I'll just kind of talk about quantitative and discretionary. So a lot of you might have already know about discretionary investing, which is like I'm an investor or a portfolio manager, and I take a deep dive into companies, right? I like study their financials, I study the market dynamics, I study the competition, and figure out if this is the right investment by figuring out if how the business will perform in the next sort of 12, 24, 36 months, or whatever the time horizon is. So really the characteristic is like, as an individual, I am on my own discretion trying to understand the business and making a bet if the business will do better or worse than the market anticipates. And I can be very concentrated, 5 stocks, 20 stocks, and the rules are kind of like on me. There are no, like, I have some principles, but there's no like hard-coded rules. And the most famous investors like Warren Buffett and Peter Lynch and pretty much anyone you might have heard of kind of falls into this category. On the other side, we have quantitative investing, which is sort of the systematic and algorithmic side of things, where we basically, the thinking behind is like, as humans, we are full of like biases, and we can like make wrong decisions based on human emotions. So we're kind of codify or systematize our process, and we're going to come up with rules. They could be like dynamic rules or static rules, but the idea is to systematize the process and sort of like use that process as investing mechanism instead of me coming off like, this is what my gut says. We're going to focus on one subset of it, which is called factor investing. And what it really is something very simple. I take list of all the stocks and I rank it by a factor. And that factor basically encodes whatever my investment philosophy is. So for example, if I'm looking for the most profitable companies, I can just rank all the companies by their profits divided by some measure of price or whatever, and just pick top 50, top 100. So that my criteria is the most profitable companies. Another criteria could be the largest companies or the small, whatever. So if I can encode in one factor, I can rank it and build a portfolio. If I, for example, this profitability factor, I take the profit and I figure out, okay, what the market capitalization or stock price is, I can get sense of like, okay, if I pay, like, let's say $100 for a stock and the company earns $10 in income, it gives me about 10% yield. So that is a concept of value factor, which is I'm building my factor based on some fundamental value of the business and not just what the stock market is saying. In a lot of empirical studies, it's been shown that value factors outperform market averages. And we're going to take a look, like a deeper look ahead. So in a standard quantitative investing process, and this is encoded by a lot of ETFs, you might be invested through your 401ks or mutual funds or hedge funds. Basically, you take a ranking. So there are a lot of funds that do dividend yields. We're going to take the best dividend yield stocks and make a portfolio of whatever top N. And then based on the diversification risk reward calculations, people come up with a number of stocks. So it could be as low as 50, which is considered quite concentrated for quantitative methods, as high as thousands. And once you have these basically rankings, you construct a portfolio by top N, and you just kind of essentially rebalance every so often, so your rankings kind of reflect the portfolio state. One interesting thing, as in the standard quantitative investing process, is when you're building these factors, for example, you're taking net income, debt, or cash flows, you may basically, let's say I'm building a portfolio and I look at Apple and I say, okay, how much money did Apple make as a net income last year or last 12 months? And I divide by its market cap. And I do that for all the companies. The challenge with that is, like, I'm using historical data and I'm making a proxy. Okay, this is what the future reflects. But intuitively, we know the returns kind of are driven by how the companies do in the future. So it is not all that relevant what Apple has earned this year or last year if it cannot replicate what's like going forward. So essentially, that's the challenge, right? Like, the returns are driven by future kind of operations, but in the standard quantitative investing process, we basically look at what has happened in the last 12, 18, 24 months and just kind of make our factors using that. And so the idea is like, well, but if the returns are driven by the future, why can't we, or should we think about forecasting the future and see if it can do better than just using historical information? And that's where we're trying to kind of improve upon the standard investing process. So before explaining any further, I want to explain this chart, which is interesting, and it's a little complicated to kind of understand. So bear with me for a second. So far, I've kind of come up to the conclusion, okay, I want to forecast the fundamentals because that tells me what the business does in the future, and that's how I get my returns. But that is a very kind of hypothesis or loose idea. What I want to do is, like, can I get a more quantitative picture of, like, what's the value of forecasting? Like, can I, like, how much benefit will I get if I can forecast? So that's the question we're going to answer in this chart. So on the list of the items, you see like book market, sales value, sales to EV, FCF to EV. These are factors, essentially. So EV is enterprise value, which means how much money do I need to shell out of my pocket to buy a certain company. So this is market capitalization plus debt. So if I were to buy Apple, I would need about $2 trillion or whatever its market cap plus debt. And that gives me, okay, my sort of purchase price. And sales and the numerator is basically some fundamental item about the company. Revenue. FCF is called free cash flow, which is how much money do I have left after paying off all the R&D, debt, everything. Like, how much do I have, essentially? And EBIT is an important one, which is earnings before interest and taxes, which is basically operating income. And this is the one factor we're going to be focusing in this presentation. So all these on the left are basically just factors which we rank our stocks by for making the portfolios. Okay, so now imagine that you are playing God and you know the future. So you know what the earnings for Microsoft are going to be 12 months from now and for all other companies. And you say, okay, if I have that information and I create my factor using that information, obviously this is hypothetical, but suppose I could do that. I know perfect information. What is the value I can realize in knowing perfect information about the future? So looking at the red curve, which is EBIT over EV value factor, 12 months, so months of clairvoyance is basically how far into the future I have information for. So 3, 6, 9, 12. So for 12 red curve, I'm saying I know Microsoft and all their companies' earnings 12 months into the future, and I'm using that as a factor. If I do that, if I create my portfolio of 50 stocks based by this factor, this is essentially most profitable companies selling for the cheapest. I get 40% annualized return for 20 years. So this is 2000 to 2019. So that says, okay, if I had perfect information, I can get a 40% annualized return. And that's obviously almost unrealistic, and pretty much nobody kind of achieves that. Yes?
Thanks. How can it be that some of the curves are downward sloping and not just monotonously positive? Because you would assume that information further into the future cannot possibly harm your ability to predict, right?
So that's a good question, but what happens is like it's not a one-to-one mapping in the sense that even though I might know perfect information about the future, but the returns are still determined by the market forces. So what you're asking, so like some of the charts are going down, that is where like the complications of the factor itself. So the factor I choose to construct plus sort of the market dynamics of share pricing, like what the company's selling for, there's not a very simple, clean relationship. Like if I have higher sales to EV ratio, I will have better returns. So it's like a factor people use, but it's not a perfect kind of one-to-one relationship like you can map out linearly. That's why it's kind of showing it's within that noisy band of like it can vary. And that's why people don't use this as factor, right? Like and most people use earnings yield as a factor or dividend yield as a factor because there's more correlation. And so people would do this and there's no correlation. So yeah. So if we look at the EBIT over EV, the red curve at 12 months, it kind of gives you about 40% annualized return. Now, obviously, that's extremely good, and very, very few people, I don't think anyone, but I can just think of one fund who's done better, but for 20 years. But what this gives us is like, okay, if I can forecast perfectly into the future, I can realize an extremely high rate of return. And that gives you sort of quantifies the ceiling of, okay, now if I try to forecast, and I know I'm not going to be perfect, but with what accuracy can I realize some of those gains over the market averages or whatever are the standard quantitative investing factors do? And that's basically the slide. Is like, okay, doing this is worth it. Like 40% is the ceiling, but there's like it is worth trying to estimate some of that so we can realize the gap between the standard and the 40% that we can get. Any questions on that? So basically, this kind of sets up like why even try this, and that's what this kind of slide is setting up. So our next sort of step is, okay, I've decided it's worth trying. Now I'm going to forecast the fundamentals. So fundamentals in finance are typically things that you find on financial statements. Every public company, every quarter releases financial statements, which includes balance sheet items, income items, and cash flow items. So things like revenue, income, assets they have, debt they have, things like that. So when it comes to forecasting fundamentals, currently we use deep learning and more specifically recurrent neural networks. Before that, we used more like other methods, but obviously we kind of like experimented with it and found out deep learning was doing much better. And there are a few reasons for that. Some of them are pretty like not kind of just related to finance, but just in general. Finance and economics data is complex and non-linear, like a lot of other data, but like specifically in finance, the data is too noisy. Economics data is too noisy. It's not coming from a physical, like physics-based kind of event. But neural networks are good at mapping complex nonlinear relationships. Also, with these neural networks, it's not that other methods can, but it's kind of easier to set up the multivariate and multimodal analysis. So multivariate is like, I want to not just income, but I want to kind of predict all the fundamentals together at the same time. And multimodal, I can combine like quantitative data with textual data. Image data doesn't really kind of come into play for finance, but textual data and quantitative data you can combine and kind of like get more information. So far, all the quantitative and pretty much all machine learning is still focused on quantitative data. So there's sort of that, at least the possibility of combining these two data sets or these two modes in getting some edge. And finally, we also kind of get uncertainty out of our estimates. Again, other methods can do this too, but it's kind of like a neat way to get it from neural network modeling. And what happens is, like, if I get the uncertainty, okay, I think company X is going to make X million dollars with the uncertainty band, it actually helps you to reduce risk quite significantly. And we're going to see how. That's why it's very important in this case to estimate the uncertainty. Basically, you don't want to be kind of wrong and confident about it, because it can like hurt you very significantly. Google, I think there's maybe last week, it was in their, I don't know if it was like a paper, but they released a blog about like building a weather predicting model, and they would do 8 or 12-hour precipitation prediction better than the weather models. And it's essentially a time series, but it's a more complex one. But it just shows how far these time series models and this modern machine learning methods have gone. All right, so now we're going to get it like, okay, how do we actually do this? Like, what's the process? So far, everything has been kind of a high level. So for this problem, we take all the US stocks between 1970 to 2019, which are traded in New York Stock Exchange, NASDAQ, and Amex. And we create time series. And we create time series for 5 years at a 12-month window. So basically, an example series would be, I take all the fundamentals, so revenue, income, balance sheet items, everything for, let's say, Microsoft in January 2000. Then I dig those same fundamentals in January 2001, 2002, all the way to 2004. And I use that to predict all the fundamentals for January 2005. And then I do that for Feb, March, and pretty much all the time series. So like at a monthly kind of rate, I do that for all the companies, all the dates, and all the fundamentals. And some of the features that go into that input is the fundamentals that I've talked about. Additionally, we add momentum. So momentum is, so it's like a technical term that finance people use, where 1 month momentum is like how much the stock has changed in the last 1 month. So it's just today's price divided by price a month ago. And similarly, you have 3-month, 6-month, 9-month momentum. What momentum helps you tell is basically momentum encodes information about what the market is thinking, right? So like if a stock drops 50% in 3 months, and let's say you haven't gotten any new financial information, or the company hasn't released the official financial details yet, but there's like some news or rumor or something that the market or the analysts have figured out, to capture that information, momentum is a really good kind of feature to capture that, like a non-financial statement information. And then finally, you have some additional information about how much short interest there is on that stock, on that company, how many people are shorting it, or what percentage of the total float is being shorted, industry group, how big is the company, these kind of auxiliary features. And so essentially, we make like one giant row, and then we have like 5 time steps for that. So it's very like a typical of machine learning model or problems. We take 1970 to 2000 data and use that to train and validate our models. And we use 2000 to 2019 to test the model. So we don't use any data post 2000 to train our model, because we don't want the model to learn from the future, essentially, because that's how it's going to be in production. And within the 30-year window, which is a 70% split, we tune our hyperparameters of the neural network using like a genetic algorithm to figure out what the network should look like. And one thing that someone might ask is like, why our goal in investing is to obviously make returns, and right, like, and we're forecasting. Why not just forecast the stock price? And which is basically every kind of like people try to do that. But the challenge is the stock price, especially 12 months out, is so noisy that there's almost no signal or very little signal, especially across, if you go across companies, like 12,000 companies. So fundamentals, which is like the underlying business, that changes much more slowly and has better signal to noise ratio than the behavioral side of the market or the stock price itself, because it is driven by a lot of other factors than just the business, right? And that's why it has, like, even though it's still difficult to forecast fundamentals, but it's better than just doing the price. And then final point is like, we are creating a factor called about we're using operating income as one of the factor inputs, but we predict all the fundamentals about the company. So we predict there are about 20 core fundamentals that we care about. So it's all like revenue, income, cash flow, debt, and all of that. And it's very interesting. We didn't know before doing this experiment. It helps making all the other predictions better. So it kind of generalizes and helps with overfitting when you try to predict everything except the one thing you care about. That was kind of like a good discovery. We didn't anticipate. And then the final piece of kind of modeling is, I have, okay, yes, go ahead. He's getting the mic.
Hi. I guess two questions. First of all, is there anything different about the past 20 years about the way the market behaves than there was before? And more specifically, how do you deal with exogenous factors like what happened in 2008, or even in like 2002? There was a pretty severe decline then.
Yeah. So 2 questions. I'll kind of just repeat.
1, 2, 1, 2. Yeah. Yeah. Can you repeat those?
Yeah.
Wasn't coming through the microphone properly.
Yeah. So there are 2 questions. One is, is there anything different in the behavior or the business or stocks in the last 20 years than like the previous 20, 30 years, right? And the second question was, how do we deal with the exogenous factors such as 08 crisis or tech bubble crash in 01 and probably COVID a couple of years ago? So I'll take the first one. Basically, market does kind of has there's so there's more like a high level answer that in general the market that they have the cycles have compressed across time. So like in the 50s, 60s going to now, the cycles have compressed. Essentially, like it's faster to like go on a boom and then bust out, and that has to do more with like the market is kind of like typically more efficient now. There was like more people are there and everything is hype, like people get information faster, they trade faster. So there's less kind of like inefficiencies in the market to exploit, or like there used to be in 50s. In the 50s and 60s, people would have to just go to the New York Fed to like print out like a lot of economic data, and anyone who could do that had an edge in doing something. And now everybody's like, it's on tips, basically on their fingertips. So that's like a more general comment. Essentially, it's kind of like compressed in terms of its reactions. In terms of like booms and busts, the human nature hasn't changed all that much. So that's still kind of like the cycles have kind of they're similar, and it's almost hard to predict like how, like when they will happen, how long they will last. So that's kind of like my only, it's not a like very specific answer, but that's the only thing I can think of that has changed over the last kind of 20 years as a general comment. The second question, so how do we deal with these exogenous factors? The short answer is we can't really. Like what happens is, and I will show you in the results section, the models do worse in those time periods. And your hope is like they do less worse or they make up in other times. Essentially, because it's hard to model these exogenous factors. And there are specific funds who their selling point is we are catering our fund for these. Like it's like an insurance. Like we don't do much and you pay kind of premium, but if something wrong happens, well, like our fund kind of returns you that performance. So that's kind of a different segment of investing, and it's more akin to getting insurance, flood insurance, than kind of long-term, like consistent. And they fit into a very small institutional investor wants that kind of exposure. In terms of models and like machine learning models, the short answer is you can't really. Like who could have modeled COVID? Nobody. And models fell off, and people's predictions were horrible. But the hope is like you kind of like try to make up in the times where it's more predictable, and don't lose a lot, and don't do horrible. And that's more to do with risk mitigation than kind of like core strategy, which is where uncertainty quantification helps. Did you have a question?
Hello. All right. Yeah.
Yeah.
All right. There it is. Okay. Awesome. Sweet. Yeah. In terms of like models, like overfitting and whatnot, like what are the I guess what are the factors for you like to sort of determine like, hey, this model's like, you know, it's overfitting and whatnot, we need to correct. Like what does that correction sort of look like for you?
Yeah. So it is basically, if your model, overfitting is essentially you have tuned or learned the training data so well that it's not able to generalize it. So like you've just catered your model to a very specific form of data points that, like if the future distribution, or not the distribution, but if the future data points differ, your model doesn't get that. And that's kind of like a very typical machine learning problem. And the way to get around it is basically, that's why you do that split of 70 and 30%. So what we do is we take the 70% data and we fine tune, we build our model, train in this data, but within this data, we take out a small sample. Within this set, there's a 70-30 split, and that 30% is used to tune the models. So basically, that's representative of the future incoming data. And in economics or any time series, that's one particular thing where like if your future distribution changes, that might be a problem. And in finance, that is a problem, right? Like the noise is data dependent. Like your distribution might change. We are operating under the assumption that it's more or less the same, our models still work okay. But in reality, there is a bit of a distribution shift. So to do like, how do you test for overfitting? You essentially have like within the training set a small set of data aside to test that against. And it's not just performing good on training set, but also on that validation set. So typically people have 3 sets: training set, validation set, and test set. You don't touch the test set only to just check, evaluate. You don't train the model or tune the model by looking at test set. You look at it, validation set. And if you're not overfitting, your training error would be much lower than your validation error. That's how you test it. Yeah. All right. So, oops. Okay. So the uncertainty quantification, which goes back to the risk part, is so far I'm trying to look at, okay, if I'm forecasting NVIDIA to make $100 million, and let's say Coca-Cola is also, my model is forecasting making $100 million. These are numbers that are wildly off. These guys make billions, just for illustration purposes. Now, how do you know, like both of the estimates are $100 million. How do you know that which, like, is one more risky than the other? Is it one better than the other? And one way to think about it is like, as intuitively, I can think Coca-Cola has been around for started in 1880 something, so a long time. And NVIDIA was started in the 90s, right? And it's more kind of like cyclical, semiconductor, tech industry, so more ups and downs. Coca-Cola is more steady state based on kind of population growth and all of that. So you have a sense that, okay, $100 million for both, but I'd still kind of like put my money, or I would say Coca-Cola is less risky just because it's more predictable. It's more likely to make $100 million next year as well than NVIDIA. And to try to encapsulate that kind of like risk profile of companies that may have the same estimate, but like they might have very different risk profiles, we use uncertainty quantification. In finance and in a lot of other fields, especially economics, noise is data dependent. And this goes back to the question you asked. The noise is different in 2008 than in 2022, than in 2017. So let's say 2015 to 2017, not much happened, for example. 08, 09 crash was a big shock. So the noise there was dependent on the data itself. So what we do is to capture that, we make it data dependent. So the opposite of, or not the opposite, a separate case would be, let's say I buy a measuring instrument, right? And that measuring instrument has some flaws, or not even flaws, but just some measuring error. And whenever you measure, it's off by 2 centimeters or whatever. So you can say that there's noise in the measuring system, but it's not data dependent. It's not dependent on what you measure, but just it's the characteristic of the measuring instrument itself. So you can measure it, quantify it, calibrate it, whatever. But if you have something where the noise itself is a function of the data, that becomes more challenging. And this is a great example where like 08, 09 noise was very different. Right now noise is different. COVID noise is very different than what it was in 2014-15 period. So this is the kind of a neat trick to like, okay, I'm using the same, like my inputs are going through the neural network, and am I outputting my mean, which is the prediction I want, which is the earnings and all the other fundamentals. But along that, I'm going to forecast the uncertainty. The model is trying to like, okay, I'm going to say it's 100 million, but along with that, I say, okay, it'll be between 80 and 120 with 90% confidence or whatever. And that gives me a sense of, okay, what the model thinks how the pattern of the sort of the fundamentals is, or how volatile that fundamental profile is. Yeah.
Do you have some sort of loss function for uncertainty as well, and how you build it?
Yes. I didn't put the loss function because I don't know how much technical details I should talk about. There is a loss function, and that loss function kind of captures this trade-off where the model is kind of like fighting between, if I make a really like confident, very tight bound prediction, but it's wrong, it's really bad, versus I can have extremely wide interval and the prediction could be like, basically can fall anywhere. So I'm not kind of giving any information to the user. So it's the loss function, essentially, there's a push and pull where like I want higher accuracy, but I also want a reasonable bound. I just don't want like an extremely wide bound where like everything I can say, it will fall between 0 and 1 trillion. So the loss function kind of captures that. And the assumption is there's this Gaussian distribution, so it comes from like a Gaussian loss function using MLE. Yeah.
I don't remember if you trained the model on the stock price. I would like to hear, if so, yes, why or why not?
Yeah.
And more generally, if you didn't train the model on every available data that you had throughout those 30 years, then why did you decide to go for fewer if you could have gone for more? Are there some concerns that perhaps more data could actually confuse the model towards predictions?
So let me ask them first, and then we can talk about the second. So the model does not have stock price data explicitly. And the reason for that is the stock price is a very noisy signal. It doesn't add any value to it. It's just so noisy that, especially for like looking at the long term, it doesn't. It's very hard to extract meaningful signal out of it. So, and we've tried it, and it's better to just like take it out. Like empirically, it doesn't work, right? The second is maybe goes back to this, like why didn't we use? Can you see my mouse pointer? Yeah. Why don't you use this part of the data?
So I think you trained the model on about 8 different factors, which you showed us before.
So the
10?
total number of factors are like 50.
15. Okay.
Yeah.
And I suppose you probably had access to more, but you decided not to.
Oh yeah. So basically, we used all the factors that we had access to, we could get, and would add value. So there's, for example, there is like a macroeconomic data, right? You can get interest rates and GDP growth and all kinds of items, employment numbers, and we didn't find that they were adding anything. So there's like some sort of like there's sort of a cap on how much signal you can extract given all the data you can, and there's like, oh, actually these extra data points or features don't add that much value and maybe just confuse the model.
Okay, but I guess from a methodological point of view, you did test various
Yes.
parameters.
Yes.
Okay, so we are supposed, if we try to do something like this, we should actually test which
Yes.
factors add and which ones detract.
Yes.
Okay.
Actually, that's also a good point. Before moving to deep learning, we had a more feature engineering like kind of test study where like we are testing which features are going to be most important ones. But when we switched to deep learning, actually was better because the models could feel like we could just feed all the data we had, and the models can figure out, and if they're good, they can figure out what to leave out. So that's what happened. Like before deep learning, we had very specifically engineered features, different ratios, different like a whole study on that. But since going to deep learning route, and one of the reasons is like we just feed the raw data, like the first level of data without feature engineering any features, and let the model in the latent space figure out, okay, what's important for me and what's not. And the reason for like not like you can add more data, which we tried, it doesn't help, but you could. It doesn't degrade the performance. That's for sure. Yeah. Yeah.
Would it be possible to train the model on specific depression era financial information and then combine that with this current model to train?
It's totally possible and plausible, I think. The only difference is there's just not enough data. Like you could take 1929 depression, 87 crash, 99, 2000, 2001, 08, maybe COVID. For finance, you get like monthly data, maybe daily, but that's only stock price. Business doesn't change daily. So in theory, if you had enough data, you could actually build models, but it's just not enough data. What you could do, and people do that, is you can build like a separate model than forecasting one, but to figure out which companies might survive an exogenous event, or basically, or like, let's say the probability of a company going bankrupt. You can build that kind of model, and we kind of do to some extent, basically trying to figure out what's a value trap, and you give all this data, and you can oversample from these like periods, and just figure out, okay, what company is likely to go bankrupt, and stay away from that, or kind of rank that. So you could do that. The problem in finance or economics data is just not enough, as opposed to user data or images or music. Like they don't have that problem. Yeah. There's a question at the back.
In the previous slide, you have mentioned that you'll remove the noise, like COVID pandemic. What if it is not just a noise? It might change the market for long term, like 4 or 5 years.
So I didn't say we remove the noise. That's actually not possible. Or actually, I shouldn't say that. There's different techniques to say that. So we didn't change the noise. We tried to model it within our model. So essentially, when we are giving the model the whole economic cycle of like decades, which has like booms and busts and all kinds of things, the model in theory should learn, okay, if like big companies are going down, that's a signal for small companies going down, or companies who are highly leveraged might be in a bigger trouble, right? Companies with have cash reserves can do better in difficult times, things like that. And model to some extent has able to model that relationship. So we don't kind of remove that noise. We try to model it through this mechanism of like forcing the model, okay, you have to predict this, how much the company is going to make, but you also have to predict what's the uncertainty around it. Like, what do you think? And that uncertainty is coming from the data itself. So it's kind of like all encompassing. I'm not kind of removing anything. What was the question about, like the 5 to 10 year periods? You had a part of the question.
Yeah, if it will change the market for like long term, like 4 or 5 years or so.
So I think that relates to his question, where like if something fundamentally changes in the market, right? So that in kind of technical terms, it means there's a distribution shift in the data, right? Like you have trained your model on some assumption or some kind of like behavior of the market, but then the behavior changes. What do? You have to either retrain it or be more conservative, like things like that. But there's no kind of like shortcut or any way around it. You either have to kind of like be more conservative or wait for new like the new behavior and encode it, get more samples, and increase the representation of that data. Yeah.
I had a question around, like you talked about deep learning models and being able to use the data as it is without doing much of feature engineering to train the models. And now the question I have is that in regular machine learning parallels, mostly we can't use the raw data as it is. We have to transform the data by either like doing averages or square roots or combine couple of data sources to come out with those specific features. So are you, in your experience, are you suggesting that we don't need to do any of it and just point it out to the raw data sources and let the let the deep learning basically use it as it is, and we completely remove the process of transformation of the data to a new format and then feed it into the model? Thank you.
So maybe I should kind of clarify. When I say raw data, there is some amount of processing that goes into, but that processing is converting the data. So for example, fundamentals come every quarter. They don't come every month, right? But you have to, so we take it like the missing data for 2 months until the next earnings report comes out. You kind of fill in that. And then you normalize the data and make the data, like standardize the data and sort of make the data so that a neural network can learn easily. So that's kind of the processing. What I meant was, I don't have to engineer features. For example, before deep learning, what we do is like we figure out, okay, if I divide debt to market cap, that's a new feature. Does it help or not? If I divide assets to cash flow or profits, in financials, profit margin is not always like a GAAP metric. GAAP is generally accounting principles. So if you create that ratio or take a log of something, does that help? Those things are unnecessary for deep learning because it can do that in the latent space, whatever it needs to do for learning the loss function. Yeah, but there is like a minimal like data processing just to make sure the format and distribution and everything is okay for the model.
Just a follow up on that.
Yeah.
So let's take for example that you are getting raw data from the stock exchange. So you get all event data for all the key stocks. Let's say NASDAQ.
Can you speak up a little bit?
Yeah, sorry. Can you hear me?
Yeah.
So let's say you have you're listening on to the raw, like the stream coming from the stock market. Let's say top 100, top 50 stocks, and you're getting event by event data, like whenever they're moving up or down, etc. Let's say that's the only data that you have. You're receiving it in real time. Now, if we were to use the traditional or classical machine learning, we would probably take like 52-week moving average, like highs, lows, opening day, closing time.
Right.
Okay, a lot of these kind of things, right? And the volatility in the stock, etc. And the trades number of like how many got sold, how many got, etc. Right? All those parameters would come, beta, alpha, etc. Now, like if we were to do the same thing using deep learning, would it make sense to not to leverage any of these parameters and just feed in the regular like the ups and downs of stocks on a like a real-time basis that we're
Yeah.
getting, and the beta and volume, etc. The deep learning model should figure it out by itself. Is that can you understand it that way?
I don't think I can answer that precisely, but because like what I can say is you definitely would not need to do as much fine-tuned feature engineering of like, okay, let me get the max of this, or okay, let me get the average of this, or whatever. But does that mean you can't or shouldn't do any basic things which might have like a higher signal? So it's hard to say, but you can get away with more towards raw data than to like highly engineered like number of features that you've manually crafted or empirically tested. Because at least in the problem that we were looking at, basically what we learned is the model is able to figure out a lot of those ratios and all those things on its own. In internal, it's in models like in its latent space. So we didn't need to like do all these crazy features. So I don't know how much within that spectrum of like totally raw, like fully engineered you can be, but my guess would be you can kind of get away with like more raw, maybe some features that are, a really high quality signal, maybe just kind of make it easier for model to figure out. But typically like deep learning models are very powerful. If anything, they'll just overlearn and overfit, but they can really understand like if there's enough data, and strong enough signal. Yeah, thanks. So one aspect of quantitative investing is simulation, right? Like we're building these strategies. We're like, how do we know how good or bad these return numbers that I shared you, like where are they coming from? So basically, you have to build a very kind of industry grade, accurate simulator, because without it, you're just flying blind in a way. So we have built the simulator, and for these like results or today's talk, we build a portfolio of 50 stocks. So like for a quantitative standard, it's considered concentrated portfolio, and ranked by a factor for companies that have a market cap of 100 million. So that's like a condition that we posed, because smaller than that, they're harder to trade and all kinds of things, and harder to build up a position meaningful enough. And we hold for this particular case, we hold the stock for 1 year for tax efficiency purposes. It includes like transaction costs, slippage. When you try to buy a stock, the price goes up. So the more you try to buy it, the bigger disadvantage you have. So you kind of have to model all those things. And then we measure annualized return and Sharpe ratio. A Sharpe ratio is a measure of risk-adjusted return. So you and I, if we both get 10% return, but one person gets it with much less risk, obviously we would favor that. So Sharpe ratio is that measure, higher is better. On the right, basically, it's a chart of like what the actual returns were of a strategy and what the simulator returns for that strategy. So basically it says simulations are good, basically. We can kind of trust those simulations to build our kind of production models. And we're getting towards the end, and I don't like to put such a slide here, but maybe it's kind of important to just to understand the results. It's a little bit of definitions. You might already know a few, but the three important things are enterprise value is just, we talked about how much do I need to like put out to buy a company full, pay off its debt creditors, and just buy it whole. And then quantitative factor model we define as a standard factor model, which is what you could do today, like what a lot of ETFs do, funds do. That's like a standard. And the LFM is defined as look ahead factor models because we're forecasting and kind of trying to look ahead. So wherever there's the LFM, that means it's a machine learning forecasting model. And then on the right, there's like a linear forecast, just a linear regression, autoregressive models. MLP and LSTM are just neural networks, different kinds. And wherever there's a UQ, it includes uncertainty quantification. So basically, there are two things before jumping into the table. When we're training this model, the question is like, okay, we like hypothesize like as we're training the model, that means our forecasts are getting better, but does that translate to better returns? And this is what the upper chart shows. Basically, we're starting our training here, where the model knows nothing. It's just a random combination of weights. And as we're and then we get like a standard, like kind of close to normal factor return. And then as we're training our model, the returns basically go increase. So that means as we're training, the forecasts get better. As the forecasts get better, our simulations or returns get better. And that's what this is basically showing. And below, it goes back to like the question you asked, these 2008. So these are the errors of our model between 2000 to 2019. And you can see there's a big spike in 08, 09. That's because the crisis happened and the models were like all out of whack. And similarly, in 14, 15, there was European debt crisis that spooked the markets. And if we had COVID, I'm pretty sure we would have a spike here too. So basically, we're hoping like these periods are good enough that, or our models, even though they're like less accurate, but so is everybody else. So it's a question of like our models, even though more inaccurate in crisis periods, are less inaccurate than others, and we can do better. And finally, basically, the results of this study is MSE's mean squared error, like how good the predictions of the model are. CAR is the annualized return, and Sharpe ratio is risk-adjusted return. Higher is better. So S&P from 2000 to 2019 did about 6% annualized. QFM, which is a standard factor model, did about 14%. And then the remaining are essentially forecast models, basically starting with autoregressive, linear, deep learning, and UQ, uncertainty deep learning. And you can see the models get more accurate, and the returns go high in the Sharpe ratio. So a UQ LSTM gets 17.7%. So it's 3.5% more than the standard, which in investing terms is pretty big. For 20 years compounded, that's a huge difference. And more importantly, the Sharpe ratio, basically you're getting more while taking less risk. And the difference between Sharpe ratio is even more significant. Basically, it's like you are going further without taking more risk. And then finally, basically, it's just plotting of those different strategies. LFM, UQ, so look ahead factor models, generate an ROI of 20x between 2000 and 2019. So 25x, I'm sorry. Standard models, linear and standard model is 15 and 12x. So just any kind of prediction is still like doing better than the standard. Like just a linear regression also gives you better than the standard, which is 12x. And UQ, the purple, kind of consistently beats in different periods. You can see like some of them may be good in some periods than others, but the UQ models, which is like the risk-adjusted models, perform consistently better across the full kind of 20-year period. And that's it. So basically, to kind of cap, what is quantitative investing? What is ranking of stocks? How we do that? How we build portfolios? And then where does machine learning come in? It comes in to forecast fundamentals, basically forecasting how the future does, how the business does in the future, and using that to build our portfolios and see how it performs, and it does significantly better. And that's it. So, and here's my email and Twitter. You're more than welcome to reach out and have any follow-up questions. And if anyone has more questions, I'm happy to answer.
Awesome. Thank you very much.
I think there's a question.
Right. Where's the questions? Let me come to you with the mic.
Yeah, I have a question. Do you have any like heavy tails problem? You mentioned you use like Gaussian model for modeling like distribution, but I heard that a lot of financial data have like heavy tail, which doesn't fit really into Gaussian thing. Yeah.
It's a fair question. I don't think you can fully map out the distribution. It's an assumption we've made, and we've seen, okay, does it map out well with the results? And it does. But if you were to ask me, does this really map to a Gaussian distribution? Not exactly, but close enough. In finance, well, it depends. The heavy tails, if you are going for high risk, high reward kind of strategies, those are much more heavy tailed. And if you're looking at these crisis periods and like these exogenous effects, again, they're heavy tails. But there's no like a perfect way to model it. We've just used the Gaussian distribution because it makes other things kind of like modeling the model and like testing it easier. And in production and other places it works out well, so we kind of kept up with it. But like from like precise mathematical definition or kind of like theoretical perspective, it's hard to say. Like I don't think it's not entirely Gaussian. So yeah, I don't have like a great answer to that.
It's more from properties. So
yeah.
Cool. Okay. Any more questions? And I would like to apologize to anyone watching this online. I sat down in front of the camera. You got a lovely view of my back. So apologies. Any more questions? No. Let me see whether any come through the chat. If you are watching this online, please drop your question in the YouTube chat. We'll bring a question to the speaker. Going once. Going twice. No. Okay. Well, thank you very much for speaking. Give it up for Lakshay. Thank you.
Thank you.
Awesome. So thank you for attending, everyone. We will be back the last Wednesday of next month, where we have a friend bot. We've all heard about OpenAI, ChatGPT, and all that. So our speaker next month has built a friend bot using a Raspberry Pi, a speaker, and all the OpenAI services. So join us for that. Otherwise, for the folks online, thank you for joining us. We're going to stop the stream now. For the folks here, there's still more pizza. You're not allowed to leave till it's all gone. Cool. Thank you, everyone. Thank you.